listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to another episode of the Daily Gold Podcast. Thank you so much for joining us today. With me is returning guest Brent Johnson. He's CEO of Santiago Capital. And I have to say, listeners will probably recall, Brent's interview that he gave, I believe it was in February or March, talking about the potential for the dollar to make a run and gold to have a correction deeper than most people thought, which would give precious metals bulls a buying opportunity. That was dead on, folks. So that's why I'm having Brent back. Brent, let me get right into it. So with where the dollar is right now, let's talk about the medium term, like let's say a 6 or 9 or 12 month outlook. Is there something that can stop the dollar from going much, much higher? Is the only thing temporarily we have a deep recession and the Fed is forced to cut rates again? And I know they really don't want to do that, but is there something like that could at least stop the dollar for a year or so? Or is it something else? Or is the dollar at the start of what can be an uninterrupted run for, let's say, 12, 18, or 24 months?
Yeah, so all good questions, and the timing is actually pretty good to kind of have this conversation as well. Long story short, I would say that, it's certainly possible that the dollar pulls back. And if it were going to do so, now would be a very natural time for it to do so. I think when I was on with you in the spring, let's say the dollar index was, mid to high 90s, 97, 98 range. It got as high as 109, let's call it a month ago. I don't have the chart right in front of me right now. And then it pulled back a little bit. And then when, based on the most recent Fed meeting, it sounded like the Fed, while they didn't necessarily pivot, showed a path to a pivot, maybe is the right way to say it. And now the dollar's pulled back, but it's still, it's still at 106, 106 and a half. So it's very high, kind of to where it's been. And it's kind of broke out of this kind of, for 5 years, it was kind of in this 85 to 105 channel, and it's kind of above that now. But if the Fed comes out and aggressively cuts rates or moves back to QE or signals that they intend to do that, I would expect the dollar, at least in the short term, to have more of a pullback. But what I think I would caution listeners about is just because we have another pullback doesn't mean that the problem is solved. I actually think that this is a problem that will be very, very hard for them to solve. Nothing is impossible, but I think it's going to be very, very hard for them for the dollar to go down and stay down, considering all that's going on in the world. The flip side of that is if it doesn't go down here, because this would be a natural time to do it. And the reason I say it's a natural time is because the Fed seems to have slowed down a little bit. The ECB actually hiked rates for the first time in 10 years. The yen had a very big fall, but is now in the middle of a bounce. And there's a couple other central banks around the world that have been raising rates. And so if the dollar is going to fall, this is the time to do it. And if it doesn't fall and it actually breaks through that 110 level, we could be at 120 very, very quickly and perhaps higher than that. So I'm just one of these people that think this is something that you don't necessarily have to try to play it yourself, but it's critical, I think, to understand the dynamics that could lead to it happening.
Okay, so let's just make let's presume that the dollar is going to have a corrective leg down based on, let's say the Fed does a real pivot and they have to cut rates at some point. Could the dollar decline for 3 to 6 months, 12 months, 15 months? I know we're just guessing here, but what might your sense be about the corrective leg? Because who knows? It could be 18 months, or it could only be 2 or 3 months.
That's right. My guess is that if we do get a corrective leg, maybe it lasts, let's call it 3 to 6 months. I don't think it would last much longer than that. And the reason is is really, I can just point to the first 6 months of this year to show why I don't think the dollar can go much higher, much lower for an extended period of time. Because if you look and see what the euro and the yen did in the first half of the year, and I'm just using the euro and the yen because they're the two main components of the DXY index, but they're also the two kind of biggest competitors to the dollar. And I think they're kind of a good signal or benchmark for the health of major currencies. The reason that those two currencies fell so much in the first half of the year is that their economies are in trouble, and their central banks can't aggressively raise rates to fight the inflationary pressures that they're seeing. Because if they do raise rates, it's going to crush the exports and the economies of those countries. And so think about it, if the dollar falls and those two currencies, the euro and the yen, rally significantly to whatever extent the dollar falls, well, that's going to cause all the problems that they experienced in the first half of the year to be even more magnified. And the other thing that I would say is for all the people who look at the fundamental problems that the U.S. faces, we've got an enormous amount of debt. We've borrowed a bunch of money with interest rates at really low levels. If interest rates start to rise, we will have a hard time, servicing the debt, let alone paying off the debt. And as a result, we'll have to print a bunch of money to get out of it, right? That's kind of the typical bear case for the dollar. And the point I like to make is all of those things that I acknowledge could potentially happen to the dollar are already happening to both the euro and the yen. So this end game nightmare that many people foresee for the dollar, Europe and Japan are already in that nightmare. And when you consider that currencies trade relative to each other, I think it's important to keep that in mind. If you're bearish on the U.S. dollar, versus other currencies, then that means you have to pick one of them to be bullish about. And I just can't really find a bullish scenario for any of these other currencies.
Right. Yeah. And I mean, technically, we've had a huge breakout, so we're in a different against those currencies, we're in a different position than we've been in recent years. We were trading in that range, as you mentioned. But moving on, let's bring gold into it. I mean, I've been thinking about this a lot lately. First, a very big picture question on the dollar. It's obviously in a secular bull market. I mean, you can say it has been since 2011 or 2008. I mean, whatever you want to call it. Do we just have to see a vertical move to 150 or 170 on the Dixie for this secular trend to end, or does there have to be coordinated intervention? I mean, I don't think doesn't look like it's going to end anytime soon, but what do you foresee this ending? Like, go ahead.
Well, so I tend to think that this is going to take much longer to play out than many people think it will. I am ready for it to play out over the next couple weeks or next couple months, but I actually think it's going to take at least a couple years and potentially several years to fully play out. And that doesn't mean that we're going to go in a straight line higher, for the next 2 or 3 years on the dollar. Actually, the reason I think it's going to take longer than most people think is I think there will be starts and, rallies, and then there'll be pullbacks, just like what we were just talking about. And we could have several of those rallies and several of those pullbacks before this ultimately plays out. With regard to gold, I don't think gold is doing that badly. You could argue, if you don't just look at gold in U.S. dollar terms, and if you look at it in yen terms and euro terms and just about any other currency terms, gold is doing exactly what it should do. And I actually think that we will get into a period where, when enough kind of global chaos or volatility, or however you want to define what I think will ultimately be a sovereign debt crisis, I think we can get into a scenario where the dollar rallies versus all other currencies, and gold rallies versus all currencies, maybe even including the dollar. And in other words, the dollar and gold both go up together versus everything else. I don't think we're quite there yet. I think we're probably there in all other currencies. I don't think we're there yet in the dollar. I think it's very possible over the next, call it 6 to 12 months, gold kind of just trades in a band here, maybe even a little bit lower than here. I actually bought some. I'll tell you, I actually bought some puts on gold last week on the CPI print when it bounced, when it spiked on that CPI print. And I want to make something clear here. Just because I bought some puts on gold doesn't mean I'm recommending everybody to go out and sell their gold. It doesn't mean that it's appropriate for you. And I also want to be clear is I still own gold. I own a lot of physical gold. Clients own a lot of physical gold. I just put this on as a hedge because I think that was an area where we could see a pullback from. And because I am a U.S. dollar investor, right? Now, it doesn't mean that I think you should go out and you should sell your insurance policy. I think everybody should still maintain their insurance policy. I'm just not expecting gold to break out in dollar terms in the near term. If I'm wrong and that does happen, I will be just fine.
Okay, yeah. Let me follow up on that because I want to get to the point you mentioned where they could be going up together. I mean, we saw that a little bit in 2019, but what do you think? I mean, what has to change? What signals can we look for that would say, gold really looks like it's going to start moving up with the dollar? I mean, what signals are you looking for?
Yeah, so I think we could get in. Let me give you a scenario where I think it could happen. Now, whether it actually plays out like this or not, again, this is pure speculation. But this is a scenario under which I think it could play out. And I'm gonna, in addition to talking about how I think gold and the dollar could go up together, I'm going to bring in another thing that I just mentioned earlier is, people may pick up on the fact that I said as the dollar rises versus other currencies, right? And so and that's kind of been my thing all along, is that the dollar is going to be the best of all the bad currencies. And so now, when I started talking about this a couple of years ago, everybody said, oh, no, the dollar index is, going to go much lower. Well, now that the dollar index is higher, the tune has kind of changed, and it says, well, yeah, the dollar's higher versus other currencies, but it's not really higher versus other things. And therefore, it doesn't really matter that the dollar is rising versus other fiat. I would encourage people to stop thinking that way. And here's the reason why. The reason why is it does matter. It might, the relative level of fiats, if you're talking the Australian dollar versus the yen, maybe it's not as important. If you're talking about the South African rand versus the Turkish lira, maybe it's not that important. But when you're talking about any currency versus the dollar, it's extremely important. And the reason it's extremely important is because the dollar underlies the entire financial system. And so if you get a rapidly rising dollar, you will have companies start to go bankrupt. You will have asset prices start to fall. And then you will start to get, bankruptcies where you get defaults leading to other defaults, leading to more defaults. And you end up with a rapidly depreciating market such that we saw in 2008 and 9, such that we saw in December of 2018, and that we saw again in March of 2020. And even again, what we saw in the first half of this year. And so the dollar rising versus other fiat does matter. It matters for markets. Now, what I could foresee happening is I could foresee that happening again. The dollar breaks above 110. Maybe it goes to 115, 118, 120. Asset prices around the world, not just in the U.S., but in the U.S. and around the world, come down significantly. And perhaps they continue to cascade lower such that the Fed has to reverse course. They have to cut rates and they have to go back to QE. Now, I think when that initially happens, the dollar will fall. But I don't think that will happen where the U.S. is the only one doing QE and the rest of the world will continue to raise rates. I think that is highly, highly improbable. Nothing's impossible, but it's highly, highly improbable. So then we end up in a situation where everybody's printing again, right? The Chinese, the Japanese, the Europeans, the Bank of England, Reserve Bank of Australia, Canada, all of them, right? And in that scenario where fiat on a global basis is being debased, I could see asset prices rising, but the dollar still rising versus all other fiat currencies because there's just so much more demand for the dollar than there is for these other currencies that are also being printed. And in that scenario, I would think that the gold would be flying through the roof. That's kind of what we saw coming out of COVID, except for, in that scenario, the dollar was falling versus other fiat pretty significantly. The next time that we kind of have to go back to QE on a global basis, I'm not convinced the dollar's going to fall for an extended period of time. It might fall initially, but I'm not sure it falls for very long. And so I think that's a scenario where I think you have to be ready for a rapidly rising dollar. But you could get into a situation where gold and dollar are rising together versus everything else.
How does that scenario correlate with the U.S. economy and the current business cycle that we're in? I mean, we had, I guess you could call it a technical recession in the first half. Looks like there's going to be growth this quarter. I mean, the stock market's bounced pretty strongly. Brent signals are still strong, but of course, the fundamental economic data is still trending negatively. How does the potential to have a real recession over the next 6 to 12 months? How does that factor into the scenario you're talking about?
So I am of the belief that we will still see further lows in equities. I don't know if they're going to roll over in the next couple of weeks or in the next 6 months, but I think at some point in the next 6 months, call it into early first quarter of next year, we are going to see the stock market roll back over. There is no doubt that it's had a heck of a bounce here. And I'm not going to sit here and say that it's impossible that it keeps running. Maybe it will. That's what happened after COVID. You had a very hard down move and then extremely strong up move that I don't think anybody will ever forget. I'm not saying that continued to happen. I just don't think that's my base case. I still think that it will roll over for the reasons that you discussed, that potentially going into a recession. You could technically say that we're already in one. But whether we stay in that scenario or not, we'll see. I believe that we will. And so I think we are going to have another down leg in equities. But then I think, and this is where kind of my thesis comes back into play again, is I'm not convinced that we're going to have these big downturns in the markets because things get materially worse in the U.S. Or I shouldn't say that. I shouldn't say it that way. I'm not sure the catalyst for lower asset prices will come out of the U.S. It's very possible that the catalyst for lower prices comes out of China or Hong Kong or Europe or, Middle East with Russia and Ukraine. And, there could be some external catalyst outside the United States that leads to asset prices falling and that then the Fed, needs to react to in some way. And I continue to believe that the next time we have a big downturn in markets, I think it's going to start to play into country balance sheets, and it's going to become a sovereign crisis, not just a corporate or a banking crisis. And once that kicks off, I think that is when you're going to start to see a bigger flight to the dollar than we've seen already. Because once sovereigns get into trouble, and sovereign bonds start to get sold because people no longer trust the sovereign bonds, that's going to be a lot of capital coming out of sovereign bonds, and they've got to go somewhere. I think the easy place for global capital to go in that scenario is the dollar and perhaps either U.S. equities, U.S. real estate. And I actually think U.S. treasuries in general will hold up better than some of these other sovereign bonds in a sovereign bond crisis. So that's kind of a scenario where I could see overall markets turning down in the short term, but it wouldn't necessarily just be due to a U.S. recession.
Right. Now, just a couple more questions before I let you go. Now, circling back to gold, that I had 2 or 3 questions in my head. Circling back to gold, so because I've been thinking about, looking at gold's history and secular trends in markets, it seemed, I don't want to put words in your mouth, but it seems like from what you're saying, I don't want to make it too simple, but if the dollar's going up and the Fed is tightening, that's going to be negative for gold. If the dollar's going up but the Fed has, they're forced to be easy again, that would be bullish for gold.
I think as a general statement, that's accurate. Obviously, exceptions can be made, and I always reserve the right to change my mind, but I think that's a pretty good way to think about it. I think the most important thing for me when I talk to clients and people about gold is you really have to know why you own it, right? Now, if you are owning it, let's say you have a 10, 15, even a 20% position in your portfolio, as a hedge against, political stupidity or, global calamity, however you want to define that, and it's kind of a long-term play, then it doesn't really matter if it goes back to 1,500 or 1,600, or even if it goes to 1,900 in the short term. That's not why you own it. But if you own it as a trading vehicle and you're a trader, then I think, maybe you need to be more careful. But I think it's really important that you understand which of these that you are. I've talked to a lot of people who claim to be long-term investors and that it's more of an insurance play, but yet they sit there and watch every tick, and every time it moves by a little bit, they either get really excited or really depressed. And so I think you kind of need to figure out what you own, why you own it, and what the reasons that you think it's going to pay off. I cannot make any guarantees, but one of the most, without being certain of anything, one of the things that I am most sure about is if and when the dollar comes into trouble versus other currencies. In other words, when the U.S. dollar, if there ever comes a time where people choose another currency other than the dollar, that gold will do absolutely fantastic, right? And if we get into a situation where the overall monetary system is in trouble, I think gold will do fantastic. And the reason that I'm actually bullish long-term gold, even though I'm also very bullish on the dollar, is because in my opinion, there's nothing more bullish for gold than a strong dollar, because a weak dollar will perpetuate the current system, whereas a strong dollar will destroy it. And if the system itself comes into trouble, I believe that gold will put itself forward as a potential solution or as a potential replacement for that system. Now, I do not believe that the governments are going to willingly go back to a gold standard, but that doesn't mean that gold won't go to $5,000 and say, hey, look at me, So to me, gold and dollars are the two most important things for people to own right now, regardless of whether they go up or down, because I think in the years ahead, we are going to have this crisis. I think we've kind of reached the point where the consequences are going to come home to roost. And I think those are the two most important things to help you get through the crisis. Now, they may not make you the most money, but I think they will at least help you get through the crisis and have some capital on the other side that you can then kind of put to work and come out of it.
Okay, and just one more thing. I mean, obviously this can change, but so it sounds to me that you're more bullish on gold, like let's say 12 months from now than right now.
Yes, I think that's accurate.
Okay, very good. Before I let you go, Brent, can you tell our audience where they can go to follow your work, and if they want to contact you, how they can do so?
Sure. Well, I have a pretty simple website at santiagocapital.com. For regulatory reasons, I don't have too much information on there, but my contact information is on there, and you can reach me that way. I'm pretty active on Twitter. You can find me on Twitter. Santiago Capital, Santiago AU Fund is the handle. And you can also go to things like YouTube or Google and just type in Brent Johnson, Santiago Capital. I've done a number of these types of interviews and presentations, and I would encourage everybody to go back and listen to the previous ones that I've done with you, because I think those were pretty good, and you always ask good questions. So so I'm always happy to try to interact with people to the extent I can.
Brent, thanks so much for coming on today and speaking with my audience. I and the listeners really appreciate it, and hopefully we can have you back over the coming months if there's some new developments in the currency and macro world. It'd be great to discuss those again with you.
Yeah, happy to do it. I always like talking to you, so just let me know, and good luck to all your listeners.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.